All right. Well, it's 2 o'clock and we would like to get started. So I will begin by welcoming all of you to Year-End Giving After Tax Changes, What Fundraisers Need to Know. I'm Kelly Quilter. I'm a Vice President at Benefactor Group, and I'm so glad that you could join us today. The end of the calendar year is one of the most important times for fundraising. And this year, with tax policies and changing and shifting donor priorities, it's more important than ever to understand how these changes might shape giving. So today we're going to unpack what's happening, what it means for you and your donors, and how you can plan with confidence. A few quick notes about what you can expect in today's webinar. First, we'll start with a panel from our panel of experts, followed by some time for your questions. You can submit questions anytime using our Q&A feature, and we'll answer as many as we can. A quick note, while we will be discussing how tax changes may influence charitable giving, our session today is for informational purposes only. We're not offering legal or tax advice, and we encourage you to consult a qualified tax professional for any specific guidance. And finally, we'll send a recording of this presentation, the slide deck, and any other resources we mentioned today in a follow-up email so that you have everything you need to reference later on. I'm pleased to be joined today by two of my colleagues. First, Laura McDonald, Benefactor Group's founder and principal. Laura has really extensive experience in fundraising and philanthropy and is an expert and frequent speaker on topics including campaigns, endowments, and philanthropic trends, and much more beyond that. And you've probably seen her insights in publications like Forbes, the Chronicle of Philanthropy, or the New York Times. She's also the author of the Endowment Handbook, published by Wiley in 2024, and she continues to shape our sector through her work with the Giving USA Foundation, the Giving Institute, and the Generosity Commission. And next, Paul Yegayan. Paul has more than 20 years of nonprofit leadership and consulting experience, including executive roles with the American University of Armenia, Heifer International, and the Foundation for the Public's Health. He's an AFP master trainer, a certified specialist in planned giving, holds a graduate degree from Harvard, and is currently completing his Chartered Advisor in Philanthropy designation. And as mentioned, I'm Kelly Quilter. I have nearly 20 years of fundraising and university advancement experience and have led teams that include major giving, development operations, alumni engagement, and communications. At Eastern Michigan University, my team designed and led the university's largest ever campaign, which exceeded its $100 million goal by nearly 20%. So with that, let's get started. Now, before we get into the specifics of year-end giving, we'll start with a quick reminder of what we already know about the current state of philanthropy, drawing from Giving USA's 2024 report. We've been fortunate as a firm to have a front row seat to this data for many years through our participation in the Giving Institute and on the Giving USA Foundation board. So let's look at overall giving for 2024. In 2024, charitable giving in the United States reached $592.5 billion, up 6.3% from 2023, or 3.3% when adjusted for inflation. And that's a new high in current dollars. And when adjusted for inflation, it surpasses every year except for 2021, which stands as the best year of giving on record. This is a result of 2024's strong economy. Donors felt confident, and it showed in their generosity. So now let's look at who gave. Individual giving, as you can see, represents the lion's share of overall contributions. Alone, it accounts for 66% of total giving in 2024. However, when we take into account bequest giving and about half of total giving to foundations, individuals account for closer to 85% of overall giving. The strong economy also resulted in a notable increase in corporate giving last year, which reached a record $44.4 billion, though it still averages only about 1% of pre-tax profits. And when we look at giving over time, what we see is that individual giving has consistently represented this majority of total giving. But a note here, although it appears that individual giving seems to be gradually declining, What's really happening is that donors are shifting their giving to family foundations and donor advised funds. So it's not that individuals are becoming less generous. We're just seeing changes in the way that giving is tracked. And I'll add that historically, giving from bequests has seen some modest fluctuation over time, but with an estimated 18 trillion expected to flow from estates to nonprofit causes over the next 2 decades, meaning the great generational transfer of wealth, we'll likely see this change. Now let's turn to who received those charitable dollars. All 9 subsectors saw growth in 2024 in current dollars, but 3 stood out, exceeding 10% growth. And those were international affairs, education, and support for public society benefit, which nearly doubled. In case you're wondering what this is, public society benefit primarily accounts for donor advised funds held by private companies, advocacy organizations, for example, those that advocate for gun rights and those that advocate for more gun control, and also pass-through organizations like the United Way. An important takeaway here is that these 3 subsectors with double-digit growth are the ones that are traditionally supported by high net worth households. So as we think about the recipients of charitable giving over time, I want to share an important reminder here. Every subsector in 2024 received more support than the year before. What we see on this chart is that the distribution of giving is evolving. So, for example, if we look at religion, giving to religious causes continues to grow. But what we're seeing is that their market share over time has been declining. Now, we're beginning to see a higher rate of growth in market share in areas that have traditionally held a smaller share of the market, like human services, for example. And this is notable because what we know from our work and experience in higher education, for example, young alumni are often less inclined than previous generations to give to their alma mater and instead may choose to give to social or community-based causes. And so it may be that we start to see areas like human services eclipse areas like education in the future. So giving remains remarkably strong, but the ways people give and where they give are changing. There's more to understand about giving trends, even over a longer span of time than what you see here on this chart. So we'll turn to Laura McDonald for more insight.
Thank you, Kelly. And what I'd like to share with you comes from the full range of Giving USA data. Giving USA has good data on charitable giving that goes back to about 1967. And as some of you know, I had the great privilege of serving as the chair of the Giving USA Foundation board for a couple of years. And so really gained a deeper understanding of this data and how it can be so important to us. What you see right now is the base chart that I'll unpack for you a bit. If you take a look at the bars, the sort of teal bars, that represents total giving adjusted for inflation. So it is compared to what the value of a dollar is today or was in 2024. The green line shows current dollars. I don't know about you, but I sort of live in a current dollar world, and so that one is a little bit easier for me to grasp. But as you look at this, what you will see is in one of the bars, that spike in 2021, when we had a remarkable outpouring of generosity. So the largest amount in inflation-adjusted terms. And what we showed is that while giving tends to bump along at about 2% of GDP, sometimes a little under, that in 2021 it reached 2.3% of GDP. So there is elasticity in this charitable giving market. And I think as professionals, that's what we should all be trying to maximize is how can we make the pie bigger, not just fight for a larger slice of pie for my organization. But as you can see, it tended to grow, particularly in current dollar terms. It grows at an average rate of about what the growth was last year, so just over 6%, about 2.5% when adjusted for inflation. And that all-time high in 2021 was influenced by a number of things. You'll remember for many of us, there was not discretionary spending as we were still at home waiting out the pandemic. And then we also were moved by what we saw in the news about food insecurity, about a racial reckoning. So, if we take that a step further, and why I think it's particularly relevant for today's conversation is that if we take a look at when charitable giving has declined or been stagnant, what we know is that since 1967 in current dollars, it has only declined 5 times. It doesn't always keep pace with inflation, but it has only gone down 5 times. And so I think one reassurance we should all take away from this is that it is a remarkably resilient part of the American economy. But when we look at those declines, you can see that two of them happened 2008, 2009 in the teeth of the Great Recession. That was a difficult time. One of them happened from 21 to 22, just because 21 was so extraordinary that there was a bit of a reverting to the mean in 22. But the other times that giving has either declined or really languished came the year after major tax reform was adopted. So you'll see that from 2017 to 2018, when the Tax Cuts and Jobs Act was adopted, what we see in the data is that there was a run-up of giving in the year before that tax law took effect, and then a bit of a decline, a lull of giving the year after. Same thing happened back in 1987, 88, when another major overhaul of the tax code occurred. And so here we are in October, almost November of 2025, looking at the last quarter of the year before major tax changes take effect. And I think that we should all buckle our seatbelts and anticipate that for some donors, it will be more advantageous. You're going to hear more about this to give this year. For other donors, it's going to be more advantageous to wait. But the data would tell us that we may anticipate a run-up of giving yet this year, and then a bit of a lull early next year.
Just a few high-level things here around the impact for everyday donors, also known as people who do not itemize their tax forms. So again, one thing to start with is that most households do not itemize. So since the tax law of, I believe, 2017 took effect, only about 1 in 10 taxpayers do itemize. Now, beginning in 2026, there is going to be a very attractive, simple on-ramp for non-itemizers. This is the universal charitable deduction. Basically, that means up to $1,000 for single filers and up to $2,000 for joint filers when they make a cash gift to a public charity. So really, I would think of this as kind of the larger successor to the CARES Act, temporary $300 and $600 deduction that we saw back during the pandemic in 2020 and 2021. Now, a couple of important guardrails around this. These above the line gifts, if you will, for non-itemizers can't be made to donor advised funds or supporting organizations or private non-operating foundations. They simply don't qualify. On a practical level, what this means is that some higher net worth, everyday non-itemizers may wait until 2026 to contribute. So we might see some softer giving from them by this year's end. But I think the ultimate takeaway here is that the motive to give has not changed. There's simply a new incentive that may have a modest down pull at the end of this year, but I think we're going to see increased giving from non-itemizers starting in 2026. And we can talk a little bit now about sort of the impact on major donors or people who do itemize. Now, starting in 2026, there's going to be two significant shifts in the behavior that we're going to see from itemizers. First is there's now going to be a 0.5% of AGI floor. So that means that only the portion of annual giving above that amount can produce a tax deduction for the donor. Second, what we're seeing is a 35% cap. This is down from a current 37% cap on the value of itemized deductions for the highest income filers. So practically what that means is that the tax benefit starting in 2026 is going to be 35 cents per every dollar deducted. Now, just to give a quick example, if a donor has a $600,000 adjusted gross income, you've got a 0.5% floor is going to be $3,000. If that donor makes a $10,000 cash gift to your organization, 7,000 of it is potentially deductible, with the top bracket savings cap for them being around $2,450. So the takeaway here is that it's important for fundraisers to be able to explain this new 0.5% AGI floor, but also to really start to spotlight and highlight these appreciated asset gifts, which are going to become increasingly more attractive for major donors, and also to expect more strategic bunching that Laura talked about a little bit earlier. Now, there's a couple of other additional considerations to make as we move to the next slide, and that's that starting in 2026, there is going to be this $6,000 deductible for those born before 1960. So this is an age-based personal deduction. This is not a charitable rule. So it's going to apply regardless of whether someone itemizes or does not itemize. It's not going to change the $1,000 to $2,000 universal deduction or the 0.5% floor. What it does mean is that people born before 1960 are going to have a little bit more wiggle room, which means that this is an opportunity for nonprofit organizations to translate that wiggle room into more charitable giving. Now, an additional thing to consider here is what we call qualified charitable distributions. So these are gifts from the donor's IRA account if they're 70 and a half plus in age. A qualified charitable distribution is sent directly from the IRA custodian, that could be Fidelity, Vanguard, et cetera, to the charity of the donor's choice. What's very attractive for older donors is that this contribution is excluded from the donor's income. So this 0.5% floor or the 35% cap that are going to be happening starting in 2026, they're not going to apply. A couple of things to consider with QCDs is they cannot be used to fund DAFs or supporting organizations or private foundations. So this is very good news, I'm sure, for most of those on this call. And also, it's important to note that for donors age 73, 75, depending on where they were born, there is a required minimum distribution from their retirement account. So again, this can be a particularly attractive tool for older donors to use. Another thing to consider also is that there is a one-time QCD contribution to establish a charitable gift annuity or a charitable remainder trust. Now, there are a number of rules around that. I believe the cap is at $54,000 for this year, but it is something, particularly if you do have charitable gift annuities. This could be again a very attractive thing for them for donors to explore. Finally, I think we really want to drill into these appreciated stock, mutual funds, and other real property. These can be extremely attractive to donors. So the takeaway from the previous slide was you definitely want to promote QCDs. You definitely want to encourage those before 1960, born before 1960, to stretch their gifts a little bit and to expect a lot more bunching and more asset-based gifts. Now, looking as Laura pointed out a little bit around corporate donors, there has been a pretty significant change here, and that's that beginning in 2026, corporations may only deduct charitable gifts to the extent that it exceeds 1% of taxable income, up to the existing 10% cap that they have right now and is going to continue. What this is likely going to do, as Laura mentioned, is that we may see some decreased giving from corporate partners. However, on the upside is that we may see corporate partners looking to fewer, larger multi-year commitments, with potentially some dollars shifting to marketing, HR, ESG budgets instead of philanthropic contributions. So the main takeaway with this is that nonprofits should consider offering multi-year opportunities to corporate partners, and then optionally, layer some fee-for-service modules. So that can be employee engagement, co-branded content. That would be under a separate scope of work and certainly from separate budgets. But a lot of corporations do want to be involved, so it is important to consider those things. And last thing on that is that those deductions are determined for corporations are determined year by year. So when you're going to do a multi-year opportunity, you want to make sure that you structure those annual payments to help corporations clear that 1% floor.
So to summarize, thank you, Paul. To summarize all of that, a few things. For itemizers, for those who itemize perhaps their state and local taxes, their mortgage interest on their tax returns, it may be better for them to give before the end of this year. And in fact, we have clients telling us now that some of their donors are opting to prepay to pay their campaign pledges off early to take advantage of this situation. We're also hearing about a lot of use of donor advised funds to fuel giving. And while for non-itemizers, they will have a more tax advantaged giving situation after the first of the year. The challenge for all of us is that we can never be truly sure who in our donor database is an itemizer and who is not. It's not as simple as segmenting it by the size of the gift. Sometimes very high net worth households make relatively modest gifts. Sometimes everyday donors or those who are on fixed incomes but have significant assets make large gifts. One of the resources you'll receive from us after today's webinar is, I would call it a buck slip, something that you can tuck into or adapt for any of your direct response or for your website, just to let donors know that they need to make the decision about which way to go there. Certainly for corporations, as Paul mentioned, so if you've got a corporation that has corporate pre-tax profits of $100 million, and that corporation gives $2 million a year, I would say a few things. First of all, let's celebrate that corporation because they are giving 2% of corporate pre-tax profits. And as you heard Kelly say earlier, the average in America is 0.92% of corporate pre-tax profits. And now Congress has introduced this bar that they have to jump over, which says that the first $1 million that corporation gives is not tax deductible. They will have to pay taxes on it. And if they're an average corporation, they're going to have to pay $210,000 worth of taxes on it. Where do you suppose that $210,000 is going to come from? It's probably going to come out of their charitable giving budget. And so I know Ernst & Young did a study for the independent sector that is thinking that this may lead to a double-digit decline in the amount that corporations give annually. Some ways to adjust that, as Paul said, does the sponsorship become marketing dollars rather than charitable dollars? Does a volunteer engagement become workforce development dollars rather than charitable dollars? Ironically, marketing dollars and employee engagement dollars are fully tax deductible as a legitimate business expense. And so the thing that we're advising all of our clients is to make sure that you have multiple points of contact within the corporations that support your organization. And then finally, for DAFs, the DAFs really affect the timing of a gift. They allow a donor to separate the timing of the gift from the actual decisions about to whom they're going to give and how much they're going to give. For many donors, they will choose to use a DAF. I'll be transparent. My husband and I talked about it. We're going to put into our DAF enough to cover our typical charitable giving for 3 years. So we'll be making all of our gifts out of a DAF at the Columbus Foundation for the next 3 years. And I think that you will see, we're a relatively modest household compared to some of those that are really going to be affected by this change in the tax code. So if there were some key takeaways for all of you, I would say that first of all, historic data shows that charitable giving is absolutely resilient. So, take all of this information in, use it to inform your strategies and your messaging, but also understand that what we see is that there's amazing resilience in the generosity of the American donor. And so that those tax changes, if your donors are paying attention, it may cause an increase in giving before the end of this year. So we've also joked to make sure somebody's at the office answering the phones until 11:59 p.m. on December 31st, like we did in the old days. and that you'll want to proactively communicate with donors, position yourself as a thought partner. Make sure, don't stand in the way of their own tax advisors or wealth advisors, but certainly be a thought partner in helping them think through what is the best way for you to achieve your philanthropic aspirations. Might it be gifts of assets? Might it be a qualifying charitable distribution from your retirement accounts? So there may be other ways in which to do that. The other thing I will say is that for everyday donors, some of our donors, this is not really going to enter into their consciousness until they're doing their 2026 tax return. So know that we're going to have to keep talking about this all through the next year, because it's not until they sit down to do their tax return in 2026 that they're going to discover that their gifts were either not deductible or deductible. So this is something that we're going to need to continue talking to them about for at least the next 18 months. And everybody else is facing this as well. I think that if we all can message positively and proactively, we can ensure that more and more donors understand what's going to be happening in the environment. And as I see, we're about out of time, and I'd like to thank everybody for joining us today and for the good conversation I see in the Q&A. Yes, we will be following up. You'll get a copy of this recording. Kelly, I know that there's some other resources that people are going to get as well.
That's right. I will let you know too that we will provide a number of additional resources that are referenced as part of the conversation today, including the slide deck and a few other attachments that have some helpful language you might reference. And please know that if we didn't get to your question, don't hesitate to reach out. We're always happy to keep this conversation going. And finally, I just want to say on behalf of all of us at Benefactor Group, thank you for the work that you do every day to advance your missions and serve the common good. Have a wonderful rest of your day and best of luck as you head into the year-end giving season.